turning back up as the economy improves and as interest rates start to come down to reasonable levels. So deposits grew by 16% over December, with most of the growth coming from low-cost accounts. Average deposits are up 21%. Advances picked up from March low to June a little bit, and from June they've shown a substantial improvement. So the 9-month profit before tax is up 3% to 86 billion as a group. The core domestic number is down by about 6 billion, about 10 billion from last year. Normalized, it's down by 6 billion, primarily due to flattening interest rates and higher provisions. In terms of our core international business, excluding the impact of sovereign bonds, which is actually very positive, we have a 77% growth, with our core business reaching $31 million. Is now our international, which had till about 3 years ago been a drag on our earnings, is now a solid and sustained contribution to the bottom line. The PAT is up by 1% to 43.3 billion. In terms of some texture on our domestic business, the NII is up 5% as spreads soften by 66 basis points as the rate cycle turns year on year. Fees, again, an area where we have dominated the industry for many years, up 16% off a very high base, up to 28.6 billion. As usual, almost half of the growth in fees has come from the cards business, but with very strong contributions from banking fees, bank assurance, and remittances. As a result, total revenue grew by 10% to over rupees 200 billion. Admin expenses up 19%, due to inflation and normal salary increases. Variable costs make up a very large portion of the increase, and those are obviously then offset on the other side with higher revenue, as you can see from the strong growth in card fees. Provisions are up 10.7 billion, primarily on aging and IFRS 9 related provisioning. In the absence of IFRS 9, the provisioning charge would have been actually significantly lower. Next slide, please. So with the return of some credit demand, there is a bit of loan growth that is picking up and will continue to pick up as we go through into the fourth quarter. The infection ratio, there is an uptick as the NPLs have increased this quarter due to the addition of a couple of names. But the specific coverage, we've managed to keep the provisioning prudent in order to maintain our coverage at over 90%. Next, please. The question that's going to be on everybody's mind, the tax ADR, it has turned around during Q3 to reach nearly 40%. Our total CAR has gone up, helped by the fact that the DSIP buffer has been reduced, thereby increasing the Tier 2 eligibility. Tier 1 CAR is about 10 basis points ahead of where we were in December. The NIM, again, as we've seen, continues to slide a little bit, going from 6.3 to 6.2 with the turning of the rate cycle. The cost to income ratio has come down year on year, and we have seen a reduction in cost to income on a quarterly basis for the third consecutive quarter. Quarter 2 was lower than quarter 1, quarter 3 is lower than quarter 2. The returns obviously are down from last year's peak, but still in the high teens target range, nearly 17% and near 1% on ROA. EPS is flattish, but the book value, there is a huge swing as the previous large negative mark-to-market positions have swung around, both as some of our low-yielding portfolio has matured and gone out, and also due to first the significant cut in interest rates and the policy rate itself. But then even after the 350 basis point cut in the rate, there has been another reduction in the market rates as further rate cuts are expected. So the valuation of our bonds has improved considerably. That's it in terms of the formal presentation. And as always, we will now throw the floor open to questions.
Thank you, Raymond, for the detailed presentation. Now we're going to open the floor for Q&A. I just want to give some initial instructions as always. We are not going to entertain any anonymous questions. So if you want to write a question in the chat box, kindly identify yourself and your company name so that we can, undertake that question. Also, if you want to ask a question directly, please use the raise hand button. Okay, so I have a couple of questions directly. Raza Jafri from EFG. I'm allowing Raza to talk now. Raza, please go ahead.
Farhan, thanks so much. And good afternoon, HBL team. Congratulations on a strong set of results, especially I think the deposit mix improvement and I think the cost, the reduction in the admin expense growth, I think notable achievements. Just a few questions, if you'll allow me. The first is with respect to asset quality. I think, Raymond, in your slides, you mentioned that there were some problem credits in steel, real estate, and oil and gas. What's the general outlook on asset quality? And more specifically, your slide mentioned that you have about 33% market share in agri-finance, and that's an area which is coming in for, it seems as if the government will go after it as far as taxation is concerned. So what's the general outlook for asset quality and then specifically within the agri space?
The picture hasn't changed much compared to when we spoke to you last time. We continue to see headwinds in oil and gas, steel sector, auto sector, and the construction side. The good part is at least the rest of the portfolio continues to perform strongly. The general view is within the capital space or the leverages or balance sheets of most of the obligors, they are well positioned to capitalize on the lower interest rate going forward. The margins are quite strong, or at least on the coming back up across our major exposures. The challenge on the agri side, as you pointed out, that's something that continues to be there, especially within the wheat segment. The good part, though, is the portfolio has performed very well, where we haven't seen any major uptick in any of the extended exposures there. And within an extension of that is the SME exposure that we have on the rural side. That's been doing quite well and quite strong so far. I think just to highlight, if you look at the NPL ratio, it has only gone up from 5.8% to 6%. As pointed out by Raymond, the major provisioning that you're seeing are as a result of the IFRS stipulations, where there has been a significant contribution because of the movement from stage 1 to stage 2.
The other thing, Raza, is I would hazard to say that the infection ratio will probably remain flat or maybe even turn down by the end of the year, because a lot of the large NPLs that we were going to book, the bank has already recognized. And with loan growth kicking in the fourth quarter, that denominator will actually now start to grow. So the asset quality number itself should start to come down.
Excellent. Thanks so much for that. My second question is on costs, and we've seen inflation in the last few prints. CPI has come down into the single digits. And if that persists into the next year in Pakistan, we're talking single digits CPI. Is that something we can sort of translate into cost growth for HBL also, that your cost growth will also gravitate towards what the inflation number is?
Single digits at this point may be a bit of a stretch, but we are seeing our cost growth coming down significantly, right? If we look at this year, we've had 2 banks declare results. Our cost growth has been less than the other bank, that is the other major bank that has declared results. We're at 17% versus 25%. We've also started a very significant bank-wide cost optimization program, which has resulted in some of these numbers you're looking at. The cost to income ratio for the 3rd consecutive quarter has shown a decline. we expect to continue making savings in costs on premises and technology in particular, as we re-examine both our processes as well as some of the spend that we are doing.
So a couple of things I would like to add over here is we're really taking a two-pronged approach. So one is we are focused on efficiency and we'll see the outlook. But at the same time, we will invest and we will continue to invest in the technologies of the future, because we firmly believe that this digital journey is here to stay. New technologies like AI, generative AI, these are going to be the baselines, which are, if you want to differentiate yourself longer term, these are things that you do have to adopt and really build into your ecosystem as your driver of growth for the next. So in no ways will we be compromising, on our future strategy. But at the same time, I think there was a lot, and there still is, a lot of opportunities for prudent look at these things. So we are not going to do, Raymond, as we've discussed, anything which is inappropriate. We do have a business to run. We are the largest bank, and we will continue to do that. We will also continue to serve, where appropriate, the national causes, that we have supported in the past, and we'll continue to support them in the future.
Thank you so much. I realize I'm taking a lot of time. Just a last question, and that pickup in the surplus on reval was very visible. Just a question. I mean, if that is something that does come in for realization, are we talking this coming through the P&L or comprehensive income, say in 25?
If that does come, most of that is obviously on bonds, right? So even those that are booked in comprehensive income, when they realize, they will recycle through the P&L.
Understood. Thanks so very much. Thank you.
But
Yeah.
at the same time, we will strike a balance between realizing gains and building accrual income on our book.
Understood. Makes sense. Thanks so very much, everyone. Thank you.
Thank you.
Thank you, Raza.
Thanks, Raza.
Our next question is from Samyullah Tariq from Park Kuwait. You can speak now.
Assalamu alaikum. Thank you so much for giving me the opportunity to ask the question. I just wanted to ask, what's the difference between the tax ADR and domestic ADR?
Sorry?
What's the difference between?
What's the difference between tax ADR and domestic ADR, as it was mentioned in your presentation?
The computation is slightly different. The domestic ADR is for our lending and deposits in Pakistan. The tax ADR is really based on our unconsolidated accounts, which includes overseas branches as well.
So basically,
and tax ADR is a gross ADR, whereas the domestic ADR is based on net advances. The computation methods are different.
So basically, if you lend more in overseas market, that might even help you in avoiding the tax on lower ADR.
Yes, but then
By
that causes other problems, that is very high risk weighted. And we're not about to go wild in overseas markets where we don't have as much customer knowledge or presence as we do in Pakistan.
So we will take a prudent approach and balance all those factors out. I will have to excuse myself. I do have an urgent meeting, so Raymond will continue to chair the earnings call for the remainder of it. My apologies to everyone. Raymond?
Thank you. Thank you.
Okay.
Ravi, does that answer your question?
Yes. Thank you so much.
Our next question is from Mohammed Abrar from Arif Habib. Abrar, you are good to go.
Assalamu alaikum. Thank you for taking my question. So there has been some discussions around entities securing borrowing at a quite low rates, even as low as gap of -12%. In light of this, does this present any advantage for meeting the bank's ADR target?
Sorry, I don't know what you're talking about. Can you just repeat the first part of your Question I didn't hear.
Basically, the banks are lending at a lower rate, like IBOR -6%, IBOR -8%. So does this benefit banks in terms of meeting their ADRs?
Yes, it definitely benefits the banks. I mean, it adds large assets onto the balance sheet. And at the same time, since these are government guaranteed assets, they carry zero risk weight.
Okay, so won't it be hitting the bank's profitability?
It will be hitting the bank's profitability, but one balances between failing to meet the ADR target versus the impact on profitability.
Fair enough. Okay, so my second question is, could you provide an overview on the floating rate instruments, tenure-wise, along with their effective yields? And similarly, breakdown of tables would be appreciated.
Look, I'll give you the broad overview of the breakdown. So around 22-23% are fixed rate PIBs, another 30% are treasury bills, and the rest are floating rate. So around 45-48%, 47% are floating rate PIBs.
Okay, thank you so much.
Thank you, Abrar. Our next question is from Sayyida Khadija. You're good to speak now.
So as the policy rate comes down, the advances yield will start to reduce. And we do expect advances yield to come off fairly significantly during Q4.
I think she meant the total volume of advances, I think.
The volume of advances will grow and now will continue to grow. I think overall, for the year, we'll probably have about a 7 to 8% growth over last December, because with the policy rate now coming down, the demand has resuscitated. Pehle, when everybody kept on saying banks aren't lending, frankly, there wasn't enough demand in the market. The whole private sector credit as a whole was substantially down. So as the demand picks up, lending will continue to pick up. As HBL has said for many, many years, we are ready to lend. We will stand by customers through the cycle, through all cycles.
Yeah, so if the question is around, further provisioning because of the profile of the credit rating, as Raymond pointed out, the slide in the financials of most of the obligors has slighted away. The leverages are more or less more stable. The cost of financing is coming down. That will allow better cash flows, and that will have an impact on the ratings, which seems to be going to be better compared to where we are today. After the full year financials come through. So any releases that you see are going to take some time. But the expectation is that the velocity for the additional provision is expected to come down.
Thank you, Khadija. Next question comes from Nihal Qasim. Nihal, you're good to speak now. Hi, Nihal, you're good to speak now.
Yeah, sorry, I was on mute. I wanted to thank management for a fantastic presentation. And you noted a lot of areas where volume is growing and you're getting market share. And one of my concerns is that all the things we talk about are really small in number. such as agri, SME, and I understand that we look at this as the future and it's going to grow. But how can you help us look at it in terms of financial value add? How does it convert to the bottom line? At what time does it convert to the bottom line?
For the bank, it actually converts to the bottom line right away. Because on SME and agri, I mean, the rates are slightly higher than it would be from lending to a large corporate. From consumer, we get a very large chunk from fees. The bulk of our 26 billion rupees on fees comes from the consumer business. So the smaller business do contribute to the bottom line. And again, we outnumber, I think, every bank in terms of our agri and SME lending. But by sheer size, the corporate business will continue to dominate as it does in almost every market. It will always continue to dominate.
Sorry, my question probably wasn't clear. I guess what I was asking was, how does it convert to the bottom line given the cost base that has gone into it? How do you measure that? At what point is it value accretive? Or what's the gestation of this investment that we're doing? At what point does it become accretive in terms of the bottom line against the costs?
See, one can't specifically strip out the costs, but yes, these are all profitable businesses on their own. When you load the costs of branch network, when you load the costs of credit, these are all profitable businesses on their own, both SME as well as agri.
The fact is that the size of the portfolio, if you look at both the SME as well as the agri side, are quite significant, and the velocity of gain within those segments has been quite significant over the last couple of years.
Okay, so let me put it in another way, right? So as investors, and we're long-term investors, and we see the goal that the bank is pitching, right? But it's not translating into compared to peers into a bottom line growth or a dividend or even the stock price, which is the barometer, as how people are evaluating it, right? So and there's this huge cost element there. It's the cost to income is higher than other banks, and in absolute number terms, because it's a large bank, it's higher as well. So I guess my question is, for us to be able to quantify this big cost base, right? What numbers should we be looking for to be able to understand? I mean, I can understand you're pitching us the size of the agri portfolio, and you're pitching us the size of market share. When does it convert to leading revenues as well? And are these easily imitatable when the right time comes? And what's the change in environment that will trigger it? Is it digitization? Is it a falling interest rate environment? What is it going to be? What should be my marker that I should be looking for?
The falling interest rates will definitely help, but these are already accretive to the bottom line. They are translating into a very high top line revenue. If you ask why they're not translating to a share price, let's start with the dividends. This market, frankly, values dividends over future growth prospects. And if you give the biggest dividend, you're going to have the highest share price. So that's fundamentally why the share price is not at the same level of peers, because our dividends are not at the same level of peers.
So is it fair to then conclude that going forward, as the interest rate environment changes, as Pakistan digitizes, you would have a more stabler base of top line against your peer group? Because up till now, they're all lending to the government, and as all these things come into check, that's really the marker that we're waiting for? Would that be a fair conclusion?
We are doing much more than lending to the government. In fact, the peer group is the one that's lending to the government.
That's what he's saying.
Yeah. So then we should be, as rates come off, and also if you look at some of the other banks, particularly the Islamic banks, where there is no minimum deposit rate, with that spread coming off, I think in terms of our top line, we'll be much better off than many of our competitors. In terms of a top line, in terms of dividend, that's a different matter. We can't control the dividend policy of our competitors, but there are people who are right now paying out 90% of your earnings. Is that prudent? Also, we are subject to higher capital requirements than many of our peers.
Right. Thank you so much.
Thank you, Nihal. Our next question is from Syed Fawad Dasti from K-Trade. Fawad, you can speak now.
Assalamualaikum everyone. Thanks for taking the time out to answer a few of our queries. What I would like to understand is that obviously we were in a high interest rate environment over the past, let's say, 2 to 3 years, and that was driving deposit growth. Now, as the interest rate cycle comes off, how do you see deposit growth panning out? Let's say not in the near term, but let's say 25, because we all know that to meet the ADR, all stops are being taken right now.
Look, in terms of deposit growth, I think everybody is looking at optimizing their deposit cost. And people, the ones back, in 22, 23, market share becomes such a dominant indicator that everyone was chasing it at frankly ridiculous pricing. As interest rates come off, there is going to be more of an opportunity, certainly in current accounts. And we have seen that through the cycles, we've seen high interest rates, we've seen low interest rates. But nominal GDP, money supply keeps growing at a fairly constant 12 to 15% if you take any long-term horizon. So deposits as a market will keep growing by 12% or so over an extended period. And as long as that keeps growing, bank deposits will also keep growing, at least, in the low to mid double digit, mid-teens, I think for the foreseeable future. There will be blips in the deposit rates that people are offering, but ultimately the overall market is not going to shrink.
Right. My second question is, I know that the bank is also a primary dealer bank, right? So does that impact investment yields in certain ways?
Yeah, so I'll take that. Look, the main purpose of primary dealer is that banks or institutions will participate in the auction and distribute it to the wider market. So the main benefit is in terms of a wide distribution of government securities. We could potentially not be a primary dealer and still invest through another primary dealer and manage our book accordingly. So primary dealership is not the way to increase your own balance sheet yield. It's a way to have a more effective market for government securities.
All right. Sorry, just one more question. This pertains to the loan book. Obviously, this was addressed to an extent earlier about the NPLs and what could possibly happen. With the rat race that is going on right now and the ultimate target of 50%, is there a possibility of a higher risk associated with these new lendings?
No. I think that was simultaneously quite emphatic. First of all, a lot of the rat race, as you correctly put it, is going into government-backed loans. But also, I can categorically say from our side that we will be lending to mostly to our existing customer base. We are not going to go down market or chasing brand new customers in order to meet a particular target.
All right. So that doesn't necessarily mean that you'd be able to reach 50% in one quarter.
We are targeting to reach 50%, but that doesn't mean we're going to do crazy lending and risk having billions of provisions in the following quarters.
Thank you so much, sir. Thank you so much.
That I can pretty categorically state, and I have both our corporate bank head and our risk head sitting with me.
Thank you, sir. Best of luck with that.
Thank you, Fawad. We have a follow-up question from Sayyida Khadija. Khadija, you can talk now if you have a question.
Sorry. May I please request you to speak just a little louder, please?
Am I audible now?
Yeah, thanks.
Yeah, thank you for taking my question again. I just wanted to ask a bit about the outlook we have for the investment yield. I know you mentioned that a bit of like the balance figure for investment, but I want to understand how we see investment yields coming along, because we did notice that the yields did did experience an uptick this quarter. So how do we see them in the future?
I think the question was, how do you see your investment book proceeding with declining rates? Is that the question?
Yeah, but in terms of the interest, that is the, the the interest rate that the bank is charging, like the bank that is getting on the investments.
Okay, so as I understand it, so how do we strategize and manage our book going forward in a declining interest rate environment? So let's not forget that we have a lot of liabilities which are repriced as well. So we look at both sides of the balance sheet, not just one. We have over 2 trillion of savings deposits, which are repriceable potentially every month or every MPC. So the thing is that our overall NIMs might actually go up depending on the size and rate of cuts, MPC cuts. You see, the issue right now is that market yields are already anticipating very sharp cuts in interest rates. So market yields are well below the policy rate and even savings rates right now. So there's an anomaly in the market. And the quicker that yields come down, the better, because then the yield curve will normalize and allow banks such as us to make a reasonable spread on our deposits. So that's how we're looking at it. Yields will come down on our asset book, but so will the cost of funds. So as I said, it's a balancing act. And we feel in pretty good shape, depending, regardless of where the rates go. So even if we see sharp cuts in rates, I think we're well positioned because, as I said, we'll see a big fall in our cost of funding as well.
Thank you so much, sir. Thank you for such an elaborate response.
Thank you, Khadija. Okay, so we have a few questions in the chat box, and there was also some questions that were sent earlier. I will quickly go through the questions that were sent in advance. There was one question from Richard Desai from Asia Frontier Capital. What are outlook for benchmark interest rates by end of 2024? So Risha, and this is from a couple of other people also, maybe you can comment on that.
Okay, so again, the voice isn't coming through very clearly. So let me just clarify the question.
What's the interest rate expectation for the end of the year?
End of this year?
End of this year.
So looks like it'll be south of 15%. I think that's pretty much baked in. I would hazard a guess in the 14s, so 14 to 14.5 looks likely.
Okay, thanks, Risha. The question on PIB mix totals, I think you've spoken about that earlier. ADRs we have talked about. There was a question on target cost to income ratio on consolidated basis. Raymond, you may be
Our
able to
target
answer.
cost to income ratio remains around the 50% mark. We're not targeting a 35-38%. As the president mentioned, we will continue to support Pakistan's economy. We will continue to contribute to national causes, whether it's the work that we did on FATF or work on other areas of the economy, such as clean energy, such as climate. And so we will continue to support the government wherever that support is needed. We will continue to do things like sponsoring PSL. And therefore, our cost to income will remain higher because we are going to do a lot of things that others will not do.
Okay. Raymond, there's one more question from Altamash, Dowd Investments. I want to know why your NIMs came low this quarter. Are you seeing cost cutting since NIMs are down? I think you mentioned a little bit on the cost side already, and the view on the ADR. So maybe if you want to specifically talk on the NIMs.
The NIMs only fell from 6.3 last quarter to 6.2 this quarter. And that is, just a function of the fact that interest rates have come off so sharply. So floating rate bonds are repriced, T-bills are repriced. As I said earlier, most of our portfolio is relatively shorter term and more liquid.
Okay, I think we're probably done with those questions. There are a few in the chat box, so I'll quickly run through.
Sure.
The first one from Hassan Raza. I think most of his questions initially were answered. There's one on Rishad, this is for you. Are there any upcoming maturities and investments in the ongoing quarter? If you want to comment on that.
Well, I'm
maybe
not going to
first-
get too granular on that, but you know, there's a constant cycle of churning of maturities and repricing and reinvestment. So it's not out of the ordinary.
Okay.
I just leave it at that.
Okay,
It's
sure.
on a pretty normal cycle.
Remember, a couple of questions from Hassan Raza from Maple Leaf for you also. One is asking, do you think HBL's market share in remittance is commensurate with its size and scale? Can we expect the market share to reach 13-14% in the next 2 to 3 years? And he also has a question on quality of deposits in terms of the current account mix. HBL remains subpar compared to competing banks. Maybe you can comment on both.
Sure. So our remittance market share is certainly not commensurate with HBL size. We would prefer a remittance market share somewhere in the high teens, which is what we're working towards. We are in the process of final testing of our remittance product and remittance systems. And I think from the first quarter of 2025, we will see a pretty good uptick in our remittance market share. In terms of our quality of deposits, I think, yes, we right now are underperforming the market on current accounts. We are doing it in terms of our mix. We are doing a number of things to rectify that, both. But if you look at some of the other banks, they're managing the current account ratio to stay high by pretty much driving away almost all term deposits. So that tends to help. But as interest rates come down, I think current accounts will become a more attractive proposition for all customers.
Okay. Then there's a follow-up from Raza from EFG. I think he's mentioning, you talked about the cost optimization plan. The president also spoke about it a little bit. He wants a little bit more color, if you could share on that.
Yeah, so look, what we are doing is we are looking across the board at everything. So, for example, where we're while staying within State Bank guidelines, we may have a lot of ATMs that are very low transaction, very low value, where you've got one transaction in every 3 days. Does it make sense for us to have an ATM there? And every single ATM, including every offsite ATM, including ATMs in very remote areas and branches in very remote areas, are all supported by redundant dual linkages. So that's one area we're looking at. We're looking at solarizing our branches. We have already, through a very limited scale pilot, achieved savings of something like, I think, 24 million rupees a month. So that's headed for about a 250 million rupee save a year on this limited scale alone. Our biggest cost, if you notice, is the cost of sending SMSs. We are working with alternate vendors because, frankly, the telcos are just raising rates without any check. And every bank is paying very high rates for SMSs because it's also a regulatory restriction. So we are looking at ways in which we can offset this cost by minimizing the amount of promotional SMSs, by using our mobile app to send messages, and by working with alternate service providers to reduce the cost of the SMS. So we're going very, very granular in a number of large areas. Another very large area where we have a variable cost for us is the fees we pay to Visa, MasterCard, because we are the largest card provider. So again, we're looking at rationalizing those. We're looking at whether we really need all the services that we are paying for, and whether some things can be better done locally rather than going through Visa, MasterCard. So it's wide-ranging, it's covering every area of our operations, and it's very granular.
Okay. I think Mr. Amar Qureshi also wants to comment maybe one of the questions earlier, so I will just allow him to speak. Amar, you can speak now.
No, there's a matter. I don't think they've raised a hand.
Oh, okay. Okay. Sorry. I thought you might be wanting to comment on something. It's okay. Okay. There's a follow-up from Nehal.
Yes.
Thanks again. And so I want to I want to appreciate that you go so granular in all your costing and have the command in numbers. But at the same time, there's an exact opposite message that whatever Pakistan wants, we'll do. And what concerns us as investors is there an unlimited budget for that? How do you control? How do we as investors know?
For what? For what? Sorry?
For PSL, for PSL, etc. I mean, how do you rationalize it as to what should be the budget? And if Pakistan has to digitize and grow, what's the budget over and above running the bank like any other bank would?
So the goal here is that HBL is Pakistan's preeminent bank, and our number one goal is to contribute to Pakistan's economic growth and development. Some of that, I think the work we have done with PSL, I don't think one can frankly quantify the benefits. It has been single-handedly responsible for bringing international cricket back to Pakistan. Would you say that's our responsibility? Maybe not. But then a lot of things in this country happen through the private sector. Another example where we far stand out from the competition is in terms of our charitable giving. We have a foundation to which we give 1.5% of our profits annually, fixed. We spend about 1 to 1.5 billion in contributing to worthy causes. So those things will continue. Whether one can quantify those and put a price tag on that, I don't think so. But that is something that we, as Pakistan's oldest and largest bank, will continue to do.
So there's no cost to income number for it. Like in our minds, can we put a number of 4%?
There cannot be. There cannot be on such things.
Okay, thank you.
Thank you. Okay, I'll just quickly run through some of the remaining questions in the chat box. Okay, there's Rishad, this is for you. So you already mentioned about south of 15% for December. Hassan Raza from Maple Leaf is asking what are your expectations for June 25 and your thoughts on PKR USD parity?
Okay, so the first one is I think the bulk of the cuts probably will be finished by the end of this year or very early next year. And the reason is that research is showing an uptick in inflation first and second quarters next year due to the base effect and some other factors. So we feel the State Bank will follow quite a prudent policy and not allow rates to go too real rates to go too neutral. They'll want to maintain a healthy positive real interest rate. So that's the first thing. So I would suggest that you still see low teens by middle next year, and probably carrying on throughout the rest of the year. And following year, perhaps you'll see another rate cut cycle coming through. But next year, I think it'll be a fairly cautious rate trajectory. In terms of the exchange rate, as of now, there's very little pressure on the rupee. But of course, that as the economy starts picking up, then you should see some imports start coming through, and then that would obviously lead to some pressure on the rupee. But we don't see that before middle of next year. So for now, the exchange rate outlook is pretty sanguine. It's pretty stable.
Okay, a few more questions for you. So this is Sana Tawfiq from RFB Limited. She's asking that with interest rates showing a downward trend, obviously there are opportunities to book capital gains. Basically asking in terms of your strategy, if you want to comment on that. And to add to that, there's also a question on the loss on forex income from Yusra Farhan. Why was this, and will this trend continue in 4Q?
Sorry. Let me just take the forex income one. What's the question?
Was a loss on FX income. Why was that? Will this trend continue?
Let me answer that. The loss on FX income during the quarter, and we have said this before, one has to look at the FX and derivatives together. We have a number of cross-currency swaps which are hedged by FX placements. During the quarter, the rupee appreciated, resulting in a loss in FX, but a corresponding gain on the derivatives line. We've seen this before when the rupee appreciated very strongly in 2023, when we saw huge gains in the FX line in the first quarter, but equally huge losses on the derivatives line. So they kind of go together. So the loss is entirely caused by the loss on the cross-currency swap on the FX leg of it during this quarter. In terms of our core sales business as well as our trading business, those numbers have improved year on year.
Okay, and Britta, if you want to comment anything on the strategy with regards to the bonds.
Well, as we mentioned, we need to strike a balance between continuing steady NI and taking capital gains. And that'll continue. I mean, we're not going to suddenly start realizing all of our capital gains, because what that means is we're realizing positive income on them. So positive NI as we hold them. So for now, we're quite happy to just farm out selectively capital gains, but to hold on to the bulk of the banking book assets. Look, we do churn a lot of our securities through the trading book, probably more than any bank. So typically our portfolio is 170, 180, 220 billion just in our trading book. That's where we realize a lot of the capital gains. The other ones, the bulk of them I have kept in the banking book, and the idea is to support the NI of the balance sheet, which is, pretty standard, accepted best practice across the globe. So we've continued to do that, and hopefully realize good capital gains as well as maintain NI over the cycle.
Thank you. Raymond, just final two questions. Those are for you. This is Sunny Kumar from Topline. He's asking if there was any ADR tax recognized in 9 months, and how confident are you in meeting the ADR target for 50% by December? And there's a question from Sana, that's the last one, talking about maybe if you could give a little bit more color on this, on the provisioning bit with IFRS 9 in the stages 1, 2, 3. So those are the last two questions.
So in terms of the ADR tax, no, we have not recognized any ADR tax during the first 9 months, because we are very confident that we will achieve the 50% mark. Or that at least we are trying our level best to achieve the 50% mark. But, it will be what it will be. But at this point, we do not expect to be taking a provision for ADR tax. In terms of the color on the IFRS 9, I'm not sure exactly what kind of color you're looking for. What the impact that IFRS 9 has caused is that previously there was a gradation in provisions under the prudential regulations. A loan, when it immediately became classified, the first stage was substandard, and then doubtful, and then loss. So it took about a year before the provisions aged from 25% provisioning to 100% provisioning. Under IFRS 9, when a loan defaults, the loan goes immediately to something called stage 3. And there is no gradation in terms of timing, whether it's a substandard, doubtful, or loss. So that immediately gets provided at a much higher level, because the only relief you get is for the recovery that you expect based on historical patterns. So that is one very large difference that IFRS 9 has created.
Great. So thank you. I think we're almost to the 1 hour mark. Pretty interactive session with a lot of questions. So thank you everyone joining in. Raymond, your last thoughts before we conclude this.
No, thank you for hosting our call, and thank you to all of you for your interest. We will, inshallah, now maybe even meet in person when we have our annual earnings release next year. And we look forward to further positivity towards the year end. And particularly as Pakistan's macros continue to improve, then, I think overall economy, the usual rising tide lifts all boats. So I think we'll all see better performance across banks, corporates, and the economy, inshallah.
Thank you.
On some of the strategic initiatives that we have around SME, around agri, and around digitization, we still retain our number one position. On the digital side, we continue to see not only an increase in digital transactions, but we also continue to see the ratio between digital versus our manual transactions that are processed continue to get better and better, which is also in line with Pakistan's vision to increase dramatically the bank's participation in this SME sector, as well as in the agri sector, as well as ensuring that we get to a digital Pakistan. Despite what has been the economic headwinds, what has been the compression in the interest rates, we continue to see strong overall results. In addition to that, keeping the environment in view, we have added adequate provisioning to make sure that our balance sheet is adequately secured. On the recognition side, we were exceptionally proud that we were selected for the award by PICG around the best board in Pakistan. This is just not the banks, but this is overall the best board in Pakistan. Secondly, in the recent FPCCI, we have won the award of the best conventional bank in Pakistan. This is over and above the 18 other awards that we have been recognized across pretty much all the segments, by various local as well as international forums. So with that very high level outlook, I'm going to hand it over to Raymond for some more color and details around what were the key dynamics and the specifics around these elements. Raymond, over to you.
Thank you, Nasir. And thank you, ladies and gentlemen. Thank you, Farhan and Arif Habib, for hosting our earnings call. And good morning, good afternoon, good evening to our investors and analysts, depending on where you're dialing in from. So for the third quarter, the presentation is already on the web, as always. We'll start with some of our key business and strategic goals. The first one, of course, being financial inclusion. So we now have 128,000 touch points, leading the market across branches, ATMs, connect agents, POS terminals. In terms of our customer base, over 37 million customers, the majority of which, as you will see, are now coming from non-branch channels. In terms of our global footprint, we have 29 branches across 10 countries. So we are committed in increasing access, in increasing our reach, and enabling greater financial inclusion, firstly, by providing additional access points to all our clients. Next slide, please. The second slide, again, deals with, really the most fundamental pillar of our strategy, which is to contribute to Pakistan's economic growth and development. So in terms of agriculture finance, we have, as a group, more than 100 billion out to agriculture. HBL's market share itself is 33%, more than, I think, the next two players combined. In SME finance, we are at 91 billion with a market share of 19%, once again leading the market. In consumer lending, at about 140 billion, we have, I would say, the most robust consumer business in Pakistan, along with being the largest, with market leadership, with very strong market leadership in both personal loans, autos, and cards. Our trade volumes have picked up, particularly in exports, which is a major focus of Pakistan's economic development, where our share has increased from about 11% last year to 13% this year. Whereas in transaction banking, we continue to dominate, not just lead, but dominate this market. Next slide, please. These are some of the awards that Nasir talked about. The top two are at the left-hand side. And again, the FPCCI award, in a sense, underscores our commitment to Pakistan's economic development, because, foreign publications and foreign agencies do stuff based on hard numbers, but particularly for the local Chamber of Commerce to give us the recognition of the best bank means we really are sort of walking the talk here in contributing to Pakistan's economy. And the best board, again, reflects what we've always said, is that we will keep our governance at the highest standards. Next slide, please. Our digital transactions and throughput continue to grow. Our total digital transactions this year, or rather throughput, is 18.7 trillion, up 41% year on year. Our customer-initiated transactions, 89% of those are now processed digitally. In terms of cash management, our digital throughput is up 37%, but more importantly, of the total throughput of near 14 trillion, about 71% is processed digitally, up from 66% a year ago. It goes through an HBL POS. While in debit cards, 1/5 of every debit